Good morning. This is Professor Minton, and today what we want to do is continue on with our discussion of adjusting entries in serial problems 3 and 4. This one will cover the end of serial problem 3, which are the adjusting entries. And so we need to talk a little bit about why we do adjusting entries. Well, if you can, close your eyes for a minute and visualize yourself in an office environment. And so you're one of the managers and you have clerical workers there. And so what they're doing is they're working away. And so they're stapling things, they're taking pens and they're making notes, and they're taking pads of paper and they're making notes on those pads of paper. And maybe they're putting in a new toner in the printer on their desktop. Um, there are literally probably hundreds of different things that they might want to get from the supply room. And so, ever so often, somebody who's responsible for it, probably the office manager, goes to the supply and say, we're running short on paper or toner or whatever the case may be. And so then they go down to the office supply store and they buy some more supplies. And they come back with them and they have somebody help them unload them and they put them in the supply room. And the whole process starts over again. People go to the supply room, they take supplies out, they work with them, they use them up. And in our case, what we're looking at here is, and let's just switch right over to the chart of accounts and trial balance. And let's take a look at that particular item. And so if I come up here, and we call them computer supplies, but that's probably office supplies, computer supplies, very similar in terms of what they are. We probably, in this case, because we have a computer company, we're going to call them computer supplies, and there'll be things like paper, right, for the copiers, and there'll be toners and all the things that a computer needs, maybe some flash drives and this and that and the other, whatever the case might be. And so here's what we did. In October, we went and bought $1,420 worth of those. And then we came back in November and bought $1,125 worth of supplies. And then in December, we bought another 1,100. So on our books, it shows that we have the asset now, an asset of $3,645, which means that if it's an asset like that, we should be able to go down and get $3,645 for the asset. We obviously cannot do that at this point because we've used a bunch of it up. It's no longer there. We we spent it. We went out and we used the paper and we put the paper someplace else. It can't be used again. It's done. So, and the same thing is true if I look over here at my prepaid insurance. My prepaid insurance, I paid that for 12 months. And so typically with insurance, if I always get a refund on the unused portion if I decide to change agents or change insurance policies, whatever if I make a change, then I'm entitled to some of those funds back. In the account, it shows me with $2,220. However, I bought that insurance policy, a 12-month policy. I bought it October the 1st. So now we're December the 31st. So I've used up October, November, and December of those 12 months, or 1/4 of the amount that I originally purchased. If I look at the prepaid rent, I paid $3,300 in October, on October the 1st. I paid $3,300 for 4 months worth of rent. And so I have an asset sitting out there at 3,300. However, we're now October, November, December. We're 3 months away from the time that I bought the or paid for the rent in advance. I'm 3 months out from there, and I've got to reflect the fact in my records that I no longer have an asset worth 3,300, but it's worth something less. Okay. Now, those are typically things that we're going to adjust for. We also adjust for depreciation. Depreciation is a reflection of an asset being used up. And so, we estimate depreciation, and we'll talk about that in a minute when we get to the point where we're actually making the computation. Also, at the end of the year, what we're going to do is accrue, or what we call accrue. That means we're going to set up a liability for the unused portion, unused, I shouldn't say it like that, for the amount of wages that someone has earned, but we haven't yet paid them for. Now, we're not going to stop just because December the 31st falls on a Wednesday and we pay on a Friday. We're not going to stop on Wednesday and pay. We're just going to recognize the fact that we owe some money and there will be some expenses associated with the current period, the current year, that I don't want to have show up in the following year. So in this case, we're talking about wages. The wage expense that is applicable to the current year, in this case 2019, the amount of money that is applicable to the wage expense for that year needs to stay in that year. And then when we start the new year, 2020, we will pick up the new wages for the year of 2020. And if you think about this for a second, part of this is also related to the way that we handle our tax returns. We're going to recognize those expenses even if we haven't yet paid them. And that's what we call accruing for them. Okay, so let's flip back over now. Let me see if I can find the actual um, additional facts that we have to use in order to be able to do the adjusting entries. And let me pop back over here just for a second because I want to point you now to the December 2019 trial balance. Now, if you notice, if I look back over at the trial balance, if I can find that thing, here was the trial balance at the end of November. And you notice it's 98,659. That was the trial balance. But what we did was we made a bunch of entries into the accounts in December and it changed everything. So we went from whatever that was, 98,659 to 106,884. That's the new balances. And so if I pop over here just for a second, you can see that we've had all these transactions that occurred in cash and some of the others. Withdrawals is another one. And so the balances in those accounts changed. This one was 5,600 in the original trial balance that we put together, and now it's 7,100. So, and cash, of course, 48,000. So if we come back over here, you can see that that 48,000 has now been transferred to the new trial balance as of the end of December before adjustments. Before adjustments, we haven't made our adjusting entries yet. And this is the way that it would work in the real world. We would go ahead and put this trial balance together before we actually make any adjusting entries. And so now we have, you can see 7,100 instead of 5,600 for SRA withdrawals. And the same thing would be true for this service revenue here. It went up, but I can't remember what the old one was, but it was probably like 24,000 or something like that. And so now we have a higher number here in the revenue and higher numbers in some of these other areas as well, some of these expense areas. Okay, so right now, if you look down here, you'll see that I have 106,884 and 106,884 over here. So what I've done is I've actually made a formula, and I'll just point you so you can see it. You don't have to do this. I just want you to know that what's happening here. I started with this beginning balance, and it's a debit balance. So any adjusting debits I would add, and any adjusting credits, which is the opposite of a debit, I would subtract. And that's what these entries reflect here. And on the other side, when I have a credit balance, then I start out by taking the credit balance, adding any additional credits, and subtracting any additional debits to get to my adjusted trial balance. Now, what we're going to do at this point, however, is we're going to make the adjusting entries that we're told about in the problem. So I'm going to pop back over here. You can see the following additional facts are collected for use in making adjusting entries prior to preparing financial statements for the company's first 3 months. So we're at a trial balance before adjustments. We're going to make some adjustments, and then we'll have an adjusted trial balance from which we would base our financial statements on. And I'll show you quickly probably how to do that as well. Okay, so the December 31st, and this is A, if you're trying to follow along in your book, the December 31st inventory count of computer supplies shows $580 still available. All right, so what does that mean? Well, that means that of all of those supplies that we bought, we only have $580 worth still in the cabinet. And if you think about that, that probably makes sense because we're spending about $1,100 to $1,200 a month on computer supplies. So we're buying the supplies, we're using them up, and now when we went and we counted what we had in the supply room and multiplied that times its cost. So if I had, for instance, I have 2 boxes of paper, $35 a box, then I have $70 worth of paper. And I would do the same thing with my pens and toner and whatever else that I have in that supply room. And when I got all said and done, I had $580 worth left in the supply room. That's my asset. I have on the books an asset that is much higher. Okay, so let's take a look and see how we handle these adjustments. So here are the computer supplies. Why do we want to adjust them? Well, they're assets, and we never, when we get ready to produce financial statements, we never overstate assets. Why? Well, because the bank loans us money, and we may have some existing loan agreements that are based upon things like current ratio, which is the current assets over current liabilities. And if that ratio is supposed to be 2 to 1 and we overstate our assets, then we overstate that ratio. And, make a long story short, it can be like bank fraud. We don't want that. Okay. All right. So we have to adjust that asset down to where it needs to be. And we know that the per actual count is $580. Now, on our books, and that $3,645, that came from just simply looking at all of these things that we have. Um, if I can find the supplies, here we go, $3,645. That's what I'm showing. I've got 3 purchases here, 14, 20, 11, 25, and 1100, but I've never adjusted that amount down for what I've used. Okay, so this is what this does. For the books, it's $3,645. The actual count, and that's what I'm going to believe because I just counted it and I extended the prices, is 580. So the difference has to be adjusted down of $3,065, simply the difference between what we have on the books and our actual count. So the difference is an adjustment that we have to make. And here's what the adjustment looks like. Computer supplies expense, $3,065. That's a debit. We're just transferring the supplies asset to an expense. And that's the purpose, by the way, of current assets, to transfer them from the asset to an expense designed to support our revenues. That is our revenue streams, what it is that we are in business to do. And this guy's selling computer services. So he buys these computer supplies so that he can generate revenue from them. So, for instance, I'll just give you an example. So he has to send out quotes, right? So that takes paper and toner and some cost to the actual copy or whatever. All right. So he has to prepare those quotes in order to achieve business. So he's transferring an asset, computer supply, to an expense by using it up, by using that asset up, in order to generate some more revenues in the computer services department. Okay. All right. So now what we want to do is we want to pop back over and actually make this adjustment. And so I come down here and find computer supplies expense right here. And it's a debit adjustment. And going back over here, what was the amount again? And we got to look at the adjustments. 3,065. I just wanted to make sure. 3065. That's my adjustment. Okay. And notice now that computer supplies expense, which didn't have a balance before, now has a $3,065 balance. Now, the other side of it is going to be a credit to the computer supplies themselves, the asset. I've got to reduce it for the amount that's no longer there. And you notice it told me that I had $580 worth remaining. So now on my adjusted trial balance, in my asset, computer supplies, I have $580. Okay. All right. The second one, 3 months have expired since the 12-month insurance premium was paid in advance. All right. So let's go back over here to our adjustments and see how we handle this. Here's our prepaid insurance. We bought it for $2,220 and it's a 12-month policy. So how much have we used up? Well, we would take the amount, divide it by 12, because that's how many months we bought, and multiply that times 3, and we'll get $555. That's the amount of insurance that we've used up. Now, in order to get the asset prepaid insurance reduced, which would require us to do a credit to it, we have to debit something else, and in this case, it's insurance expense. So I'm going to debit the insurance expense. I'm going to credit the prepaid insurance for $555. So popping back over here, let's find insurance expense. And it's right up here. Currently it has nothing in it. So the adjustment's going to be the first thing goes in it. 555, and then come up to prepaid insurance and credit it for 555. And notice now 1665 is what's left in that particular account. We now have an expense that has replaced the asset up here in the amount of $555. Okay, popping back over. 3 months have expired. Oops, I'm sorry. Oh, okay. Let's go on. Let's do them in order. As of December the 31st, Lynn Addy has not been paid for 4 days of work at $125 a day. So, that probably means, frankly, that she's done 4 days of work on a normal 5-day work week. And so she's making what, 6.25 a week, something like that. Okay. And so what we have to do is we have to recognize that we owe her some money at the end of the year. And that's so that we can put the expense and the liability in the year-end financial statements. So 4 times 125 is what, 500, right? Okay, so let's go back over to our account, our trial balance again, and let's find wages expense. And we should already have some stuff in there because we've been paying it right on. And it would be 500. 4 times $125 is 500. And we have to find wages payable up here because we haven't set up any wages payable before, but that's not going to be a debit, that's going to be a credit. Why? Because payables, all payables are liabilities. Okay, they go up on the right, they go down on the left. Assets, which is on the left-hand side of the equal sign, is equal to liabilities on the right-hand side plus equity on the right-hand side. So equity and liabilities go up on the right, down on the left. Okay, they're going up because we're recognizing that we have a debt that we have not yet paid. Now, again, we're not going to stop at the end of the year, and we're not going to stop on December 31st and pay that 500. We're going to pay it on Friday, which will be the 1st of January in this case, And I'll show you how we do that when we get to the closing entries. All right, on the other side again. The computer system acquired on October 1st is expected to have a 4-year life with no salvage value. Okay, well, popping back over here, let me explain to you how we calculate straight line depreciation. You're going to start out with the original cost. In this case, it was 20,000. We're going to subtract any salvage value, and they tell us that there is no salvage value. And we're going to divide whatever that result is by the number of years of useful life. Now, ordinarily, we would just divide it by 4. However, in this case, we didn't start until October the 1st. So I can't take a full year's depreciation. Okay? That now, before somebody says, well, what about half year conventions and all of that? Let's not get into that yet. And right now, let's just look at it in terms of um, what we would actually do for this particular thing. And so 4 years, 4 times 12 months is 48 months. And the reason I'm doing that is because I have to calculate only for 3 months. So now if I look at this calculation, I have 20,000 divided by 48 times 3 months, because October, November, December, that's all I'm allowed to depreciate this year. So that's equal to then this number minus this number divided by, and I want to make sure that this happens first. So what I'm going to do is I'm going to put this in parentheses, because that's the way we do it. And again, you don't have to worry about this because I'm doing it for you, but I just want you to see what would happen if you were actually making this computation. So here we have, when we look at this, this is how much it is per month. $416.70 per month. Okay. Well, how many months do we have? We have 3 months. So if I say that this is going to be equal to this number times 3, I get $1,250. And that is the amount of depreciation expense that I'm going to record on the computer equipment. So I'm going to come over here to my adjustments, 1250. Now, here's where it gets kind of tricky for young folks, okay? The other side of this is not cash. It's not the actual equipment itself. What it is an account called accumulated. That means we're going to accumulate it. We're gonna continue to add it all up for the life of this equipment. The in this case, the accumulated depreciation of 416.75, I'm assuming, per month. We're going to look at that over a 3-month period, and then we're going to add it to accumulated depreciation, which is a contra asset. That means it goes against or offsets the asset, computer equipment. And now you see that the accumulated depreciation is $1,250. So here's what I have. I have $20,000 worth of computer equipment that I've depreciated total at this point, $1,250. So if I needed to know what the book value of that equipment was, it's this minus this, or $18,750. That's what the book value, the net book value of that equipment is right now at the end of 3 months. Now, over time, we will continue to reduce that amount by the net book value amount by adding to this accumulated depreciation. So next year, it'll be a full year for the 12 months. And so to get an idea what it's going to be next year, that number times 12. So 5,000 next year. And if you think about it, that makes sense, because if you divide this number, because there's no salvage, by 4, you get $5,000 a month. or $5,000 a year. I'm sorry, $5,000 a year, and that's all that's happening here. All right, so let's get rid of that for a second and go back over because we've now done our depreciation for our computer equipment. The office equipment acquired on October 1st is expected to have a 5-year life with no salvage value. And again, because I'm working with a 3-month period here, and you always want to check your dates. Since I'm working with a 3-month period here, I can only take 3 months. All right, I can't take 12 months. I'm only going to take the 3 months that I've had it. All right, so let's go back over, and I'm just going to change some of these numbers. The office equipment, I'm told, is $8,000. I'm also told that it's a 60-month term. That is 5 years times 5 times 12 is 60. And so when I now make this multiplication, I'm going to get $400. That is 8,000 minus 0 because they tell me there's no salvage. If there were salvage, I'd have to subtract it. Divided by the number of months times the number of months I've actually had it. In this case, 133 times 3, and I get 400. Okay, and so if I come up here and I find a depreciation expense office equipment, 400, and over here someplace I'm going to find my accumulated depreciation. Oh, there it is. Good. I thought for a minute I hadn't picked it up. All right, 400. There we go. All right. And again, my net book value in this case is 7,600. It'll be this number minus this number. At the end of the first year, that is 2019, since I only got 3 months worth, of my net book value on this office equipment now is 7,600. This number minus this number. Okay, clear as mud. Also notice right now, and I'll pull this up a little bit to make sure you can see it, 5770, 5770. So we know that we are in balance, and you have to make sure that you're always in balance with a debit and an equal credit. Okay. All right. Back over one more time. And this is the prepaid rent that I was trying to move forward with a little bit faster. 3 of the 4 months prepaid rent have expired. That means they've been used up because we bought it and we paid through January and we've used October, November, and December. So we have to make an adjustment for it. And and by the way, if you, I'm going to send you all of this stuff so you can go back and you can check and walk through these things on how I got to everything. So don't panic if you didn't quite follow me when I was going through. This tells you why we're adjusting. This tells you what the adjusting entry is and how you get to it. Okay? All right. Now, lastly, here, we have the same situation as we had on the other asset, um, prepaid insurance. Why do we need to adjust it? Well, because it's not worth that much anymore. Um, even if we left at the end of December, we would only get back 1/4 of that amount, and so it's showing on the books as 3,300 as though it's worth $3,300, but it isn't. It's only worth, in this case, $825. And the way that we get there is we look at what's on the books, plus then subtract the amount that's used up. In this case, we have this number here, divided by 4 times 3. That's how we got to 2475. This number minus this number gives us the correct balance. Okay, that's what is in the asset. What we're trying to get to is the expense, and there's the expense. So I have a debit to rent expense of 2475 and a credit to the prepaid insurance. Oops, that says I didn't change it. Prepaid rent. Okay, so now let's come back over to the trial balance. And what did we say that was? 2475. Okay, so find the rent expense right here, 2475. And up here, we will find the prepaid rent, $24.75. And now notice it's $825. And when I come back over here and look at the adjustments, you see that that's the correct balance in the asset prepaid rent. Okay, so back over here now, I'm coming up with $109,034 at this point. Let's go check the book and see if they give us a balance. Well, 109,034. That's correct. Now, prepare an income statement for the 3 months and prepare the statement of owner's equity, prepare a balance sheet. All right. So that will be, I'm going to turn this around just in a few minutes. I'm going to save this one because this is the adjusting entries themselves. Then we'll come back and I'll show you how to create the income statement, the statement of owner's equity, and the balance sheet in the next one. Okay.